Right now, as you are watching this, the world is sitting on top of the single most explosive monetary powder keg in modern history, and the fuse has already been lit. What is happening in the Middle East right now is not just a war, it is the match that has been dropped into a room that was already soaked in monetary gasoline, and gold and silver are telling you exactly what is coming next. Pay very close attention because what I am about to show you is not speculation. This is a system responding exactly the way systems respond when they break. On February 28, 2026, coordinated U.S.-Israeli airstrikes hit Iran, killing Supreme Leader Ali Khamenei and targeting the country's nuclear infrastructure. Within hours, the world changed. Iran's Islamic Revolutionary Guard Corps declared the Strait of Hormuz closed. Over 150 tankers anchored outside the strait. Major container shipping companies, including Maersk, CMA CGM, and Hapag-Lloyd, suspended all transits. Let that sink in. This is not a threat. This is not a drill. This is happening right now in real time. The Strait of Hormuz is the world's single most critical energy choke point. About 20 million barrels of oil, roughly 20% of global petroleum liquids consumption, pass through that strait every single day in 2024, and now it is effectively shut. This is a real supply disruption, not a risk premium event. Physical barrels are being affected across crude, products, LPG, and LNG simultaneously. The insurance industry has already done what military force alone could not. Insurance withdrawal is doing the work that a physical blockade has not, and the outcome for cargo flow is largely the same. Qatar, the world's largest LNG exporter, confirmed it has ceased production of liquefied natural gas at its two main facilities at Ras Laffan and May Sayed, following military strikes on those facilities. European natural gas futures jumped around 30% following those strikes. Daily freight rates for LNG tankers jumped more than 40% in a single day. And here is what you need to understand about that number. Natural gas prices in Europe surged from $30 per megawatt hour before the conflict to $60 per megawatt hour by March 3rd, nearly double in less than a week. Energy analysts are warning that a prolonged blockade will trigger a guaranteed global recession. Former White House energy advisor Bob McNally stated directly, a prolonged closure of the Strait of Hormuz is a guaranteed global recession. And yet here is the critical piece of the puzzle that most people are completely missing. This war did not create the problem. This war simply accelerated a collapse that was already structurally inevitable, because before a single missile was fired, the monetary system was already fracturing at its foundation. Global debt levels now exceed $340 trillion, and the 2025 gold bull run was fueled by what institutional investors call the debasement trade, a collective retreat from sovereign bonds by investors concerned about those ballooning debt levels. Western investors are beginning to realize that the purchasing power of their currency has been eroded because governments have been printing a significant amount of money, and it is becoming increasingly difficult to roll over debt. The U.S. Treasury is having a very difficult time selling any long-dated bonds to anyone anymore. Read that again. The United States Treasury cannot find buyers for its own long-term debt. That is not a headline. That is a 5-alarm fire inside the monetary system. Gold rose around 64% in 2025, one of its best annual performances since the end of the gold standard. Major banks are forecasting $4,500 to $5 to ounce for gold in 2026. Gold hit an all-time intraday high of $595 per ounce, and silver reached $100 in 2026 alone. These are not bubble prices. These are not speculative prices. These are prices that are telling you exactly what the people who run the largest pools of capital on earth already know, that fiat currency is losing the confidence of the world. Gold surged above $500 per ounce on March 2nd, 2026, as the Middle East erupted into full-scale war, with the U.S. and Israel launching a massive military campaign targeting multiple locations across Iran. Silver hit an intraday high of 95.71 per ounce on March 2nd, still well below its all-time high of over $120 per ounce reached on January 29, 2026. Notice that silver already hit 120. The mainstream financial media barely covered it, but your purchasing power felt it at the grocery store, at the gas pump, in every single bill you pay every single month. Now let us talk about what is actually driving silver, because silver is not just a safe haven. Silver is the industrial backbone of the energy transition that every government on earth has committed to. Silver benefits from strong fundamental tailwinds, including deepening supply deficits and accelerating industrial demand from solar energy and electronic sectors. The silver market has experienced sustained supply deficits for several consecutive years, with industrial and investment demand consistently exceeding mine production and recycling supply. You cannot build solar panels without silver. You cannot build electric vehicles without silver. You cannot build the semiconductor supply chain without silver, and there is simply not enough of it. A rare pattern not seen since 1979 has reappeared in silver clusters of consecutive weekly all-time highs. Historically, this structure preceded silver's most explosive moves, including its near 700% surge into 1980. And that move in 1980 happened in an environment far less structurally broken than the one we are sitting inside of right now. Analysts at major institutions now forecast silver potentially reaching $100 to $150 per ounce in 2026, with the U.S.-Iran conflict serving as a catalyst that could accelerate those price targets. BRICS central banks have been reducing their exposure to dollar-denominated assets in favor of gold, and analysts expect this theme to continue. In the third quarter of 2025 alone, investor and central bank gold demand totaled around 980 tons, over 50% higher than the average of the previous 4 quarters, translating to approximately $109 billion of quarterly demand inflow. Central banks are not buying gold because they think it is pretty. Central banks are buying gold because they are preparing for a world where the dollar is no longer the unchallenged reserve currency of the planet. Gold posted its 7th consecutive monthly gain in February 2026, the longest such streak since 1973. And now understand the context of 1973. That was the year that followed the complete severing of the dollar from gold in 1971. The year the petrodollar system was being built from the wreckage of Bretton Woods, the year that began a decade of stagflation that destroyed the purchasing power of an entire generation of Americans. We are in that moment again. We are living through the transition, and most people have no idea. The Strait of Hormuz has now entered its 4th day of crisis as explosions rocked Tehran and Beirut, and crude oil benchmarks jumped over 8% in response. Bernstein raised its 2026 Brent oil price target to $80 per barrel, but warned prices could reach as high as $150 per barrel in a severe and prolonged conflict scenario. Some estimates warn of oil prices as high as $300 per barrel in an extreme scenario. When oil goes to $150, when oil goes to $300, every single thing you buy becomes more expensive. Every input cost in every supply chain on earth goes up simultaneously. That is not inflation. That is a structural repricing of reality. Rising oil prices as a result of the U.S.-Iran war are likely to place pressure on the Federal Reserve to delay interest rate cuts until later in the year. Here is why that matters for gold and silver. The Federal Reserve is now trapped If they raise rates to fight the inflation that this war is generating, they collapse a debt-laden economy that cannot survive high borrowing costs. If they cut rates or hold steady, they allow inflation to run and destroy the purchasing power of every dollar, every euro, every fiat currency on earth. There is no good exit from this trap, and gold and silver have no such trap. They cannot be printed, they cannot be debased, they have no counterparty risk. Military conflict layered onto an already uncertain macro backdrop tends to reinforce gold's appeal. Today's environment already includes persistent inflation pressures, elevated sovereign debt, and fragile confidence in policy direction. This is not one problem. This is a convergence. Geopolitical war, energy shock, debt crisis, currency debasement, supply deficits in silver, central bank diversification away from the dollar, all of it is happening simultaneously. All of it is pointing in the same direction. What we are witnessing is not a bubble, but the beginning of a paradigm shift. With most portfolios' average gold allocation under 5%, investors would need to buy a significant amount of gold to increase their holdings meaningfully, and that buying has barely begun. Gold is not designed to go up 25% and 50% per year. What is driving these gains are really powerful forces: shifting geopolitical risks, de-dollarization, central banks reducing their exposure to U.S. treasuries, and recycling those dollars into physical gold. When those forces are in motion, they do not reverse in a quarter. They do not reverse in a year. They play out over a decade. The history is unambiguous on this point. In the 1970s, heavy U.S. spending on war and social programs, financed by an accommodating Federal Reserve, raised fears of currency debasement. What followed was gold's first post-peg bull market, as double-digit inflation and geopolitical turmoil sent investors scrambling for a stable store of value. We are not at the beginning of that pattern. We are already deep inside of it. The question is not whether gold and silver are going higher. The question is whether you understand why and whether you are positioned before the next leg takes place. Because if history teaches us anything at all, it is this: by the time it is obvious to everyone, most of the move is already behind you.